when we left off, we were talking about imputed interest. So these are the exceptions / limitations for imputed interest. And I'm going to put II for imputed interest. Okay, so if you remember last time, imputed interest is income that is imposed on the lender when loans are made at a below market interest rate. Below market being less than AFR. AFR is published monthly on the IRS website, okay? And the rules for imputed interest require semi-annual compounding. Okay? So, now we were just starting to talk about this before y'all left, so we're going to go back and we're going to talk about it now. There are basically two exceptions or limitations, if you will, for imputed interest. And if you fall under one of these two categories, either imputed interest will not exist or it will be limited. Okay? So the first one is if the loan is less than or equal to $10,000, then there will be no imputed interest. This is on the slides. Let me go to slideshow, current slide. It's right here on slide 43. And for this category, to get this exception, you cannot be buying income producing property. Okay? So, like stock would be an income producing property. Buying a business would be income producing property, etc. But buying a house, unless you're going to buy it to be a rental house, that's not an income producing property. Okay? If the loan is less than $100,000, the investment or imputed interest is limited. So here we have a limit to the borrower's net investment income, known as NII in the tax biz. Net investment income. What is net investment income? Basically, income from passive sources, okay? Like interest, royalties, dividends, etc. Okay? So not wages, not earned income. If the borrower's net investment income is less than $1,000, it's actually less than or equal to $1,000, no imputed interest. Okay? So let's do an example. This is example 37 on page 423. In this example, we have Vicki. She is the lender. and she makes 5 loans during the year. Okay? She makes one loan to Susan for $8,000. Susan has 0 net investment income this year, and the loan was used for education, so to pay tuition. So, does Vicki have to pay any imputed interest for this loan? No. Why? Where does it fall here? The first one, right? Because the loan is less than $10,000, and it is not to buy income-producing property. Okay? One other thing I should mention that falls for this, it's kind of an aside, okay? It can't be for tax avoidance purposes. So in other words, if you are making this loan for tax avoidance purposes, then you don't get to use this exception. You assume that there's always a good reason other than tax purposes for these transactions, unless the facts specifically tell you it was done for tax avoidance purposes. Okay? So don't read into the problem, oh, maybe there's some tax avoidance purpose, unless the problem specifically tells you they are doing this for tax avoidance purposes, which quite frankly, if you see that in any tax problem, there is probably a red flag that should go off in your head. Because anytime something is done purely for tax avoidance purposes, there's usually a problem. And there's usually some provision in the code that won't allow the tax benefit. Okay? Same is true here. Okay? So we have no imputed interest with Susan. Okay? Now for the next one we have Dan. So Vicki loans Dan $9,000. He has net investment income of $500, and he is buying stock. So, does the loan to Dan fall under this exception here? No. Why? That's right, because he is buying income-producing property. To qualify under this exception, the loan has to be less than $10,000, which it is, okay? But he is buying income-producing property, so he does not qualify under this exception. What about this one? Does he qualify under exception 2? Yes, he does. The loan is less than $100,000. Yes, check, okay? And the borrower's net investment income is less than $1,000. So for this exception right here, it does not matter that he is buying income-producing property. Okay? That only matters for this one. Not relevant for this one. What is relevant is the net investment income. And since that is less than $1,000, there is no imputed interest for this loan. Okay? Now with the third one, we have Bonnie. With Bonnie, there is a loan of $25,000. Bonnie has net investment income of 0, and she's buying a business. So, does the first exception qualify here? Nope. Why? The loan of $25,000 is over $10,000. What about the second one? Does that qualify? Yes, it does, right? Why? Because the borrower has $0 net investment income. Okay? No imputed interest. Now we have the fourth loan, which is to Megan for $90,000. Megan has $15,000 of net investment income, and it's to buy a house. Does the first exception qualify? No. What about the second exception? No. What does qualify in the second is this limit. Now we have to look at this limit, where we say, okay, even though the borrower's net investment income is over $1,000, our imputed interest is limited to $15,000. So we have a limit, okay? So we don't turn off imputed interest, but we do have a limit, okay? So this exception can do one of two things if it applies. It can either completely throw out imputed interest if you qualify here, or it can limit it to net investment income, okay? So now let's calculate the imputed interest for this loan to Megan, okay? Now remember, we are assuming in this problem it will tell you the AFR. It'll tell you on the exam, whatever the AFR is, okay? The AFR is 10% in this problem. So we have $90,000 times 10% times 1/2 of the year, okay, which equals $4,500. Now remember, it's compounded semi-annually, so now we need to calculate the second half of the year. $90,000 times 10%. Oops, always do this. $90,000 plus 4,500. Remember from here. Times 10% times 1/2, which equals $4,725. So the total imputed interest for this loan is $92.25 for the year. Okay? Now, who pays this imputed interest? Is it Megan or is it Vicki? It is Vicki, right? It is Vicki. Don't get that confused. It is the lender who pays the imputed interest. And that makes sense if you think about it. Because when a lender makes a loan, who receives interest income? The lender. They're receiving interest income. The borrower is paying the interest. The lender is receiving it. So what the government is saying is we are going to pretend like you've received this interest, even though you actually didn't. Okay? So Vicki has interest income of $9,225. Yes?
So she's receiving it or she's paying it?
She is not receiving it because she is charging 0% interest. But the government is imputing her as receiving this income. So she pays taxes on $9,225,000 of interest income, even though she receives 0. Okay? So that's important to understand. She's not actually receiving any money. Okay? The government is saying, we are going to pretend like you are receiving this money and tax you on it as if you had. Okay? Now, last loan is to Olaf, and it is for $120,000. Olaf has net investment income of 0, and he is buying a house. Does the first exception apply? No, the loan is over $10,000. Does the first exception apply? No, because the loan is over $100,000. So now, it does not matter that Olaf's net investment income is 0. It doesn't matter because we are not in this exception. Okay? So we have no limit that we have to be concerned with. Now remember, with Megan's, we had a limit of $15,000. It didn't matter because our imputed interest was less than $15,000. So the limit didn't really help us any. Okay? But with Olaf, we don't have any such limit. So we just have to calculate it. Okay? So with Olaf, we have $120,000 times 10% times 1/2 of the year, which equals $6,000. Now let's do the second half of the year. Which is 120 plus our 6 from the first half times 10% times half of the year equals 6,300. So total imputed interest for the loan to Olaf is $12,300 paid by Vicky, the lender. Okay? Now, this is not covered in this chapter really, but I think it's good to go back and talk about it a minute. Is Vicky also going to have to pay gift taxes here? Probably not, or no, definitely not. Because remember, we have that $14,000 exclusion. So since Vicky isn't actually charging these taxes, this is also considered a gift. But we have a per donee annual exclusion of $14,000. Since both this loan and this loan have imputed interest of less than $14,000, there's not going to be any gift tax consequences to Vicky. Okay? All right. So are there any questions on this problem? Next topic in this chapter is annuity income. Now remember, this chapter is kind of all about when income is included, who includes it, some special rules for inclusion when there really isn't any income, like what we just talked about with imputed interest, and what we're going to talk about next, how much is included. So there are some special rules for annuities that tell us how to calculate how much is included. Okay? So, remember one thing we talked about the first day of class, probably the first day of class, maybe the second day of class, where we said one thing in particular is not income. We said return of capital or your investment is not income. So if you buy a house for $30,000 and sell it for $50,000, you are only going to have income equal to the difference in what you paid for it or your investment and the amount that you actually realize for $50,000. Okay? So the amount that you have expended on your behalf or your return of capital is not income. And that's all we're really looking at with annuities. So an annuity, for those of you that don't know, is when a taxpayer pays in advance some sum, whatever it is, for an annuity, and then over time, once the taxpayer reaches a certain age, they receive monthly or annual payments from the annuity. Okay? So it's they pay up front for this financial product, okay? And then over time, once they get to a certain age, the annuity starts making payments to them. Okay? So, to the extent that the payment received is return of capital, it is not included in income. Makes sense? So what we're trying to get to here is what is the piece that is the return on capital? We have to make a ratio, okay? The ratio is the investment in the contract, or what the taxpayer is paid for this annuity, over the expected return. Okay? And then we take this proportion and we multiply it times our payment. Okay? So if you multiply this, this is the ratio. Okay? This is what I call the return on capital ratio. I believe the book calls it the exclusion ratio, which is the same thing. Why? Because whatever is your return on capital is excluded from income. It's the same thing, okay? We multiply our ratio times our payment to determine how much is excluded from income. Okay? So, the investment in the contract, always easy to figure out. I paid $100,000 for this annuity. Okay? That's your investment in your contract. Whatever the taxpayer paid for it, that's their investment. The denominator, or the expected return, can be a little bit tricky. Okay? It will either be for a term of years, or be based on the annuity tables. Which are calculated in years. So, if we go to this next slide, okay? If we look under, we have a very simple example here, where we have a taxpayer paying $10,000 for an annuity that will pay $1,000 for a year. And it has a term of 15 years. So if we look at our numerator, the investment in the contract is what? That's right, $10,000, because that is what the taxpayer paid for this annuity, okay? So $10,000 over the expected return. $1,000 a year times 15 years. We have a term certain, okay, which equals $15,000. So what this ratio means is that 2/3 of every payment is excluded from income. So when the taxpayer receives $1,000 in year one, okay, $1,000 in year one, how much is going to be included in income? Approximately $333, right? And $666 is excluded from income. Why? Because it is basically a return on capital. So what we're doing is we're taking this investment that the taxpayer has made and we are allocating it over the life of the payments. Okay? We are spreading it out. So if you look, well, now what about if they don't tell you? What if they don't say for 15 years? What if they say $1,000 per year for the life of the taxpayer? Okay? Well, how do you know? Well, what's the life of the taxpayer? How long are they going to live? Well, we don't know how long they're going to live. Okay? But we do have these actuarial tables that the IRS publishes. If you look on page 426 of your book, Exhibit 4.1 has actuarial tables. What you do with these tables is you take the age of the taxpayer, okay, and you find the multiple in the chart, okay? And this multiple is done according to years, okay? So for example, if the multiple says 66.8, that does not mean 66.8 months. It means per year, or 66.8 years, okay? You have to know that because when you're calculating your expected return, you have to make sure your numbers are in terms of years, okay? So for example, if a taxpayer is going to get $500 per month for their life, and you look in the chart and it says, oh, their life is 30.4 years, you cannot just take 30.4 and multiply it times 500. That's not right, okay? You would have to say 500 times 12. We have to translate it to an annual number and then multiply it times the number in the schedule. Does that make sense? Make sure you're translating it to an annual payment, even though usually the payments are done monthly, okay? So you have to make sure you're translating it to an annual payment. So if you look, let's do an example here. Okay, this is example 39, okay? And it is on page 425. We have a taxpayer who is 60 years old, okay? She buys an annuity from an insurance company for $90,000. So right off the bat, we know that $90,000 goes where in our calculation? The numerator, right? She's paid $90,000 for this annuity. So that is her investment in the contract. Okay? She is to receive $500 per month for life. So automatically we know, okay, $500 per month times 12 months out of the year times, what is her life? Well, now we have to look at these tables. And if you go look at the table, for a 60-year-old taxpayer, the multiple is 24.2. 24.2 years. Okay? So times 24.2. So this is our ratio. When you multiply this out right here, this denominator right here, you get an expected return of 145,200. 145,200. So this is her expected return. You don't have to calculate this out if you don't want. You can just leave it 500 times 12 times 24.2. Okay? Which is what I would do. Okay? So this is her ratio. Okay? So now we take her ratio, okay, which is $90,000, over her expected return of 145,200 times, you can, if you want to figure out how much is excluded per month, you would multiply it times $500. If you want to determine how much is excluded per year, which is what matters for doing taxes, then you would multiply it times her total repayments for the year, okay, which are $500 times 12, okay, which equals $6,000. okay? So that means she is going to have a total amount excluded of $37,190. Now please note, this is the amount that is excluded, not included. So when the taxpayer receives her $6,000 during the year in annuity payments, $37,190 is a return of capital and is not included. So the difference of $22,801 is included in income. Okay? Does everyone see how that works? Now, there are two other situations, okay, that I want you to know about when it comes to annuities. Okay? What happens if the taxpayer lives longer than her estimated life expectancy? What happens? Well, then all of it is included in income. Okay? So if the taxpayer lives longer than expected, the whole payment is included in income. Why is that? What? Right. Because at that point, you have used up all of your return on capital. Because remember what we are doing with this ratio. We are taking our investment and we are spanning it out over the lifetime of these payments. Once you get past your expected lifetime, 24.2 according to the actuarial tables, the entire payment is taxable. So if we look at example 40 on page 425, we have a taxpayer that lived 25.2 years. Okay? So how much will she have to include in income? Well, she had 24.2 as her life expectancy, okay, which is, doesn't really matter what it is, but if you take 25.2 and you multiply it times 12 months, because remember, this is done according to years, that gives you 302 months, okay? So she got payments for 302 months, but she received payments, well, she was expected to receive payments for 24.2 times 12 months, okay, which equals 12 months difference, which you don't really have to break it down according to months to be able to figure that out, okay? 25.2 minus 24.2 is 1 year or 12 months, okay? So 12 months, so that means the taxpayer is going to receive 12 months worth of payments, or 12 times 500, or $6,000 of taxable income. And all of it is taxable. Okay? Now, what happens if the taxpayer dies before their life expectancy? So now we have a taxpayer that dies at, say, 20.2 years instead of 24.2 years. Okay? So if the taxpayer dies before expectancy, the taxpayer gets a deduction for their unused return on capital. So we haven't really talked about this yet, but if a taxpayer makes an investment in something, maybe it's stock, maybe it's a piece of property, and the values go south, okay, and they have to sell it at a loss, they can take a deduction for that loss, okay? The IR or the code allows a taxpayer to essentially take a loss deduction for the amount of their unused investment, okay? So how do you calculate that, okay? So, we take our initial cost of the contract, so this is our total, okay, our total investment here is $90,000. In the problem, on example 40, it says the taxpayer died after 36 months, okay? So the taxpayer died after 36 months. So she received 36 payments. So this was her total investment. Now we have to determine how much of her previous return on capital did she use. Okay? So how much did she previously get to use with her investment? Okay? So if we take 90,000 and we have to subtract it by our ratio, okay, of $90,000 over 145,200 times 36 payments of $500. So this is the amount of return on capital that she has already used, right? This is the ratio that we use from up here times 36 payments of 500 because she has received 36 payments of 500 until she died, okay? Which this total equals $11,157, which gives you a total deduction of $78,843. Because you take her total amount that she's invested minus return on capital that she has previously already captured throughout her first 36 payments, and this is the amount of investment that she was disallowed from using because she died. So this is the amount of her deduction on her final income tax return. And she will not include, well, she may include something in income. If she received a payment that year, then she will have something that she has to include in income for that year as well. Okay. There is also a simplified version of calculating an annuity. It is right here on slide 50 and is on page 427 in your book. Okay, this is simpler to calculate. You don't really have a ratio with this. With a simplified version, you take the amount paid in the contract, amount paid for the annuity, over the number from the IRS table. And the table is on page 427. It's exhibit 4.2 in the book. So if you look at example 41, we have Andrea. She is 62 years old. she pays $100,100 for an annuity, okay? And now we have to go and determine what the number is from this table, okay? Which if you look in this table, if the taxpayer is between 61 and 65 years old, there is a total number of anticipated payments of 260. Okay? So that means the excludable amount of each payment is $385. This is the excludable amount of each payment. And I don't know, yeah, it says each payment is $500. So of each payment, 115 of it will be included in income. So that's how the simplified version works. With this one, you only put the number on the numerator and then you go find the number from the denominator. Okay? Great, next topic. This is a simple topic. Prizes and awards. If you receive a prize or award, the fair market value is included in your income. Okay? There are a couple exceptions here. One is if the taxpayer designates some sort of organization to receive the prize. So if you win the Nobel Peace Prize and you decide that the Smithsonian Institute is going to receive your prize, then you would not have to include it in income. And there are a couple other requirements for this. They're on page 427 if you wanted to take a look at them. But it honestly is a pretty narrow exception. Okay, pretty narrow. The next one is an Employee Achievement Award. For this to qualify, it has to be less than $400 a year. It has to be a value of less than $400, and it cannot be cash. It has to be a tangible personal property. The next topic in this chapter, which works somewhat similar to annuities, is a group term life insurance. With group term life insurance, the code says that the first $50,000 of coverage is excludable. Okay? So the first $50K of coverage is excluded. Okay? And for each $1,000 over 50, the taxpayer must include some of it, I'll just say some, in income. The formula is a little odd, okay? But basically, it's not on the slides, but you basically have to take, so if you're looking at a formula, you would put the total coverage minus 50,000, because that's the amount that's excluded, over $1,000, because it's for every $1,000 that were over 50, okay? Times an IRS multiple, which is in an IRS table, which is in your book, times 12 months, because you have to make sure it's done annually. Okay? So, and the IRS table is on page 429. It's exhibit 4.3 in your book. And it's also dependent upon the person's age. Okay, same as these other tables we've been looking at. Yes.
So would you round down in that sense if you had like $50,500, you would only, like you wouldn't count as the 1,000? It's not always gonna.
Right, yeah,
It's not always gonna come out even into 1,000.
you would have to run the numbers. I'll run the numbers in a second and see what it comes up as, because I'm not sure, I'll have to run it. So if we look at a problem here, we have Finch Corporation, and they have a group term, this is example 42 on page 428. They have a group term life insurance policy with coverage equal to the employee's annual salary. Okay, we have Keith, which is 52 years old, and he has salary of $350,000. So to calculate how much he's going to have to include in his income, okay? And and you should note that this is the amount that is included in income, not excluded. So different from what we have been talking about with the previous problems, okay? Which makes sense because it's not really based upon his investment. He's not making an investment at all, okay? His investment is irrelevant, okay? Because he doesn't have an investment. So his salary is $350,000 minus the $50,000 exclusion over 1,000, okay, times the IRS multiple. He's 52 years old. So if you look in this chart, the multiple you have to use is 0.23 times 12, okay, 12 months, which equals $828. So he is going to include $828 a year in income for this policy. So if you were to make it 50,500, you have to get the calculator. Somewhere. Phone. You said 5,500 minus 50.
I mean, you could.
50,500 minus 50,000 equals that divided by 1,000 times the multiple, which is 0.23 times 12. It equals $1.38.
Okay.
So technically, you would have to include $1 because the IRS lets you round down. You don't have to include any numbers after the decimal in your returns. Yes.
Do we need to like write all these tables on our sheets?
If you need them, I'll give them to you. Okay. Definitely make sure you know how to use the tables, though. Honestly, they're really easy. You just need to know how old the person is. For all of them, they're based on age. Okay? Unemployment compensation. The next topic. Very quickly stated. Unemployment compensation is income. I think they feel the need to say this in the book because for a long time, unemployment compensation was not included in income. But the law was changed fairly recently, and now unemployment comp is taxable in full. There is no exception for unemployment compensation. It does seem like it goes against public policy a little bit, that you're taxing people on their unemployment check from the government, but that's the law, okay? And the last topic in this chapter is on Social Security benefits. So, a couple things you need to know that are important about Social Security benefits. 0% to 85% of Social Security benefits are taxable. So 85% is the max, okay? You cannot be taxable on 100% of your Social Security benefits, okay? So, we have this concept under Social Security benefits of modified adjusted gross income, or MAGI, modified adjusted gross income, which is basically your AGI plus tax exempt interest plus foreign income exclusion, which we haven't talked about yet, but we will next week. Okay? So, there are basically two different categories, okay, for determining how much is included in income. Okay? We have the first base amount, okay, which is $32,000 for married filing jointly, 0 for married filing separately, and $25,000 for all else. Okay? And then we have our second base amount, which is $44,000 for married filing jointly, and I'm just going to put 34 for all else. Okay. So how do you know which base you fall under? Okay. So our measuring stick here is modified adjusted gross income plus 1/2 of Social Security benefits. Note that your modified adjusted gross income does not include Social Security benefits. Okay? So this is our measuring point, is our modified adjusted gross income plus 1/2 of Social Security benefits. If this amount, okay, is less than $32,000 for married filing jointly, or $25,000 for everybody else, okay, then their Social Security benefits are taxable at 0%. Okay? So if MAGI plus 1/2 of Social Security is less than the first base, okay, Social Security taxed at 0%, which means none of it is included. I don't know that I should really say tax at 0%. I should say 0% included in income. I'll leave that there. Okay? If MAGI plus 1/2 of Social Security is greater than the first, or greater or than or equal to the first base, but less than the second base, then they're taxable up to 50%. Okay? So if MAGI plus 1/2 of Social Security, okay, is greater than the first base and less than the second base, then the Social Security income is included up to 50%. Okay? And then the third category, if Magi plus 1/2 of Social Security is greater than the second base, okay, then includable up to 85%. So this is our 85% range. This is our 50% range. And anything above this is 0%. Up to 50, up to 85. Unfortunately, it's not a straight up 50% calculation. The calculation is a little bit funny. This is the formula if you fall in the first category. Okay? So if your income exceeds the amounts, if you exceed the base amount here, but you are under this amount, you calculate under this scenario, which is this equation here. The lesser of half of Social Security benefits or half of modified adjusted gross income plus half of Social Security benefits minus whatever base amount you are using. So if you look at a problem here, in this problem, problem A, we'll look at, okay? We have AGI, and they're married, of $30,000. We have tax-exempt interest income of $3,000. And we have Social Security of $10,000. So what's our modified adjusted gross income? $33,000, right? AGI plus tax-exempt interest. And half of our Social Security benefits is $5,000. So 33 plus 5 is 38. That's the number we're looking at. 38 is greater than 32, but less than 44. So we're going to use this formula to calculate. So if we use this formula, okay, we use the lesser of half of their Social Security benefits, which is $5,000, or 0.5 times their modified adjusted gross income, which is 33, plus half of their Social Security benefits, which is 5, minus the base amount, which is 32, which equals $3,000. So with these taxpayers, $3,000 of their Social Security benefits are included in income. So let's take a look at the formula for the second category. With this category, we include an income the lesser of 85% of their Social Security benefits, or the sum of 85% times their modified adjusted gross income plus half of their Social Security benefits minus their second base amount, so the same calculation as before, but you also have to add the lesser of the amount included through the application of the first formula. So what does that tell you? Even if you fall into the second category, you still have to run it through the first formula because the input from whatever you get as the result here is an input for the second category, for the second base amount. Okay? And the lesser of the amount included through application of the first formula, or $4,500 or $6,000 for married filing joint. So, if we go to our example B. In this example, we have a GI of $40,000. We have tax exempt interest of $6,000. And we have Social Security benefits of $10,000. So here, we have modified adjusted gross income of $46,000 plus $5,000 of Social Security benefits, because we include half. So that equals $51,000. Since that is over this $44,000 threshold, we know we have to use the second formula. So if you go to the second formula, which is on, the example is on slide 59, okay? We have the lesser of 85% of their Social Security benefits of $10,000, or the sum of 85.85 times their modified adjusted gross income of $46,000, okay, plus half of their Social Security benefits of $5,000 minus the base amount, $44,000, equals $59.50, and we have to add in the lesser of $6,000, which is specified in the code, or the amount that would have been used had you gone through this first category, which here would be $5,000. So you have to add $5,000 to $59.50, which equals $10,950, okay? But since we use the lesser of the two numbers, $8,500 is the amount that's included in gross income. Which makes sense because the maximum amount that you will include is 85%, okay? So, of course, $8,500 is going to be their max. Okay, yes?
For the second part, like the lesser of, for the going through the first thing,
Yeah.
did they just take 50% of Social Security, or did they do both things and that was just the lesser of?
Yeah, they did both and that was just the lesser of. And let me say, for your exam, you do not have to know how to calculate this, okay? I'm not going to make you go through calculating this, okay? Although I'm pretty sure you do have a problem on it in your homework, okay? I will tell you the things you need to know for the exam is going to be things like this, but generally how it works, okay? If you have a modified adjusted gross income, over this but below this, you use this, you know, etc. Okay, but as far as actually running through the calculation, it is not important to me that you can manually do it. Okay? Okay. Yes, they didn't actually go through the calculation on the first one. Well, they did, they're just not showing it. Okay? If you had went through it, you would have gotten $5,000 as your answer. Okay, so are there any questions on Social Security benefits? Great. So, that's it for this chapter. Next time when you come on Wednesday, we are going to take a look at chapter 5, which will run a lot quicker than this chapter.